What is credit and why does it matter? Picture this. You walk into a bank asking for money to buy a car. The banker looks at you and asks one simple question: can we trust you to pay us back? That's credit in a nutshell. Credit is basically your financial reputation score. It's a 3-digit number between 300 and 850 that tells lenders whether you're reliable with money. Think of it like a report card, but instead of grading your math skills, it's grading your ability to pay bills on time. Here's the crazy part. You can have $1 million in the bank and still have terrible credit if you've never borrowed money before. The system doesn't care how much money you have. It only cares about how you've handled borrowed money in the past. Your credit score gets calculated based on 5 main things. Payment history is the biggest factor. Do you pay your bills on time? Credit utilization comes next. If you have a credit card with a $1,000 limit, using $900 looks desperate. Using $100 looks responsible. The length of your credit history matters too. Having accounts open for years shows stability. The types of credit you have also count. Credit cards, car loans, and mortgages show you can handle different kinds of debt. Finally, new credit inquiries can temporarily lower your score. But here's what nobody tells you about credit. The game is completely rigged in favor of people who understand the rules. You can hack your credit score by keeping old accounts open, paying balances before the statement closes, and never using more than 30% of your available credit. How does compound interest actually work? Albert Einstein supposedly called compound interest the 8th wonder of the world. He said, "Those who understand it, earn it, and those who don't, pay it." Compound interest is money making money on money. Simple interest only pays you on your original investment. Compound interest pays you on your original investment plus all the interest you've already earned. Let's say you invest $1,000 at 10% annual interest. After year 1, you have $1,100. Year 2, you don't just earn interest on your original 1,000, you earn interest on the full $1,100. That extra $10 might not seem like much, but over time, it becomes massive. Here's where it gets insane. If you invest $1,000 at 10% compound interest and never add another penny, after 40 years you'll have $45,000. Your money multiplied by 45 just by sitting there. But compound interest works both ways. Credit card debt compounds against you. If you owe $1,000 at 20% interest and only make minimum payments, that debt can balloon to over $16,000 in 20 years. The secret weapon of compound interest is time. Starting early matters more than investing large amounts. Someone who invests $2,000 a year from age 25 to 35 and then stops will have more money at retirement than someone who invests $2,000 a year from 35 to 65. That's the power of giving compound interest more time to work its magic. Should you rent or buy a house? Everyone tells you buying a house is the American dream, but sometimes the American dream can become a financial nightmare. Buying a house isn't just about the purchase price. You need a down payment, which is typically 20% to avoid extra fees. On a $300,000 house, that's $60,000 upfront. Then come the hidden costs nobody talks about. Property taxes that never go away, homeowners insurance, maintenance and repairs. When your roof starts leaking, you can't call a landlord. You are the landlord. The general rule is that you should spend no more than 28% of your gross income on housing. But here's the thing. That rule was created when houses cost 3 times the average income. Today, houses cost 8 to 10 times the average income in many areas. Renting gives you flexibility. You can move for a better job opportunity. You're not responsible for major repairs. Your money isn't tied up in one asset that might lose value. But renting also means you're paying someone else's mortgage. You're not building equity. You have no control over rent increases. You can't paint the walls whatever color you want. The math usually favors buying if you plan to stay in the same place for at least 5 to 7 years. That's how long it typically takes for the equity you build to offset the transaction costs of buying and selling. But here's what really matters. Housing should be a place to live first and an investment second. Don't buy a house you can't afford just because someone told you it's a good investment. What is inflation and how does it affect you? Inflation is the reason your grandparents could buy a candy bar for a nickel, and you pay $2 for the same thing. Inflation happens when the general price level of goods and services increases over time. Your money doesn't become worthless overnight. It just buys less stuff than it used to. The government targets about 2% inflation per year. That might not sound like much, but it means prices double every 35 years. Something that costs $1 today will cost $2 when you're ready to retire. Inflation happens for several reasons. Sometimes there's too much money chasing too few goods. Sometimes supply chains get disrupted and it costs more to make things. Sometimes people expect prices to rise, so they buy now instead of later, which actually drives prices up. The scary part about inflation is that it's a hidden tax on savers. If you keep money in a savings account, earning 1% interest while inflation runs at 3%, you're actually losing 2% of your purchasing power every year. And that's why smart people don't just save money. They invest it in assets that tend to grow faster than inflation. Stocks, real estate, and commodities often provide protection against inflation over long periods. But inflation isn't all bad. If you have fixed-rate debt, inflation actually helps you. If you borrowed money at 3% interest and inflation runs at 4%, you're essentially being paid to borrow money. How does the stock market really work? The stock market isn't a casino, even though it sometimes feels like one. It's actually a giant auction house where people buy and sell pieces of companies. When you buy a stock, you're buying a tiny ownership stake in a real business. If the company makes more money, your piece becomes more valuable. If the company struggles, your piece loses value. Stock prices move based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. It's that simple. But here's what makes it complicated. Stock prices don't just reflect what a company is worth today. They reflect what investors think the company will be worth in the future. That's why a company can report great earnings and still see its stock price fall if investors expected even better results. The stock market has historically returned about 10% per year over long periods, but that doesn't mean you make 10% every year. Some years you might make 30%. Other years you might lose 20%. The 10% is just the average over decades. Most people lose money in the stock market because they try to time it. They buy when prices are high because everyone's talking about how much money they're making. They sell when prices are low because they're scared of losing more. The secret to stock market success is boring. Buy diversified index funds. Invest regularly regardless of what the market is doing. Don't check your account balance every day. Give compound growth time to work. Why do banks want your money? Banks aren't doing you a favor by holding your money. They're running a business, and your deposits are their raw material. Here's how banks make money. They pay you maybe 1% interest on your savings account. Then they lend that same money to someone else at 5% interest. They pocket the 4% difference. This system is called fractional reserve banking. Banks only keep a small fraction of deposits on hand as cash. The rest gets loaned out immediately. If everyone tried to withdraw their money at the same time, most banks would collapse. That's why the government insures bank deposits up to $250,000 per account. The FDIC guarantee prevents bank runs, where panicked customers rush to withdraw their money. Banks also make money from fees, overdraft fees, ATM fees, monthly maintenance fees, wire transfer fees. These fees often target people who can least afford them. But banks do provide valuable services. They make it easy to pay bills electronically. They provide security for your money. They offer loans when you need to buy a house or car. The key is understanding that banks are businesses, not charities. They're trying to make money from your money. Shop around for the best rates and lowest fees. Consider online banks that often offer better terms than traditional brick-and-mortar banks. How do taxes actually work? Taxes are the price we pay for civilization. Roads, schools, police, fire departments, and national defense all get funded through taxes. Income tax is the big one most people worry about. The United States uses a progressive tax system, which means higher earners pay higher rates. But here's the key thing people misunderstand. You don't pay the top rate on all your income. Tax brackets work like stairs. You pay the lowest rate on your first chunk of income, a higher rate on the next chunk, and so on. Even if you're in the 22% tax bracket, you're not paying 22% on every dollar you earn. There are different types of income that get taxed differently. Ordinary income from your job gets taxed at regular rates. Capital gains from investments get taxed at lower rates if you hold the investment for more than a year. Deductions reduce your taxable income. The standard deduction for 2024 is over $13,000 for single filers. That means the first $13,000 you earn is essentially tax-free. Tax credits are even better than deductions because they reduce your tax bill dollar for dollar. The child tax credit, earned income. Tax credit and education credits can significantly reduce what you owe. The biggest tax mistake people make is getting a huge refund. A refund means you gave the government an interest-free loan all year. It's better to owe a small amount when you file, which means you kept your money working for you instead of the government. What's the difference between good and bad debt? Not all debt is created equal. Some debt can actually make you richer. Other debt will keep you poor forever. Good debt helps you acquire assets that appreciate in value or generate income. A mortgage lets you buy a house that might increase in value over time. Student loans can increase your earning potential. Business loans can help you start a company that generates profit. Bad debt is used to buy things that lose value or provide no financial benefit. Credit card debt for vacations, clothes, or restaurants is almost always bad debt. Car loans are usually bad debt because cars depreciate rapidly. The interest rate matters too. Low interest debt might be worth keeping even if you could pay it off. If you have a mortgage at 3% interest but can invest money at 7% returns, you're better off investing than paying off the mortgage early. Credit card debt is almost always bad debt because the interest rates are so high. The average credit card charges over 20% interest. It's almost impossible to invest money and consistently earn more than 20% returns. Here's a simple rule. If the debt helps you make more money or buy an appreciating asset, it might be good debt. If the debt is for consumption or depreciating assets, it's probably bad debt. The goal isn't to avoid all debt. The goal is to use debt strategically to build wealth rather than destroy it. How do you actually build wealth? Building wealth isn't about making a lot of money. It's about keeping a lot of money. Plenty of high earners live paycheck to paycheck because they spend everything they make. Wealth building follows a simple formula. Earn more than you spend. Invest the difference in appreciating assets. Repeat for decades. The first step is controlling your expenses. Track where your money goes for a month. You'll be shocked at how much you spend on things you don't really need or want. Small expenses add up to big money over time. The second step is increasing your income. This might mean developing new skills, changing jobs, starting a side business, or asking for a raise. Your income is your wealth-building tool. The more you earn, the more you can invest. The third step is investing consistently. Pay yourself first by automatically investing a percentage of every paycheck. Start with whatever you can afford, even if it's just $50 a month. The habit matters more than the amount when you're starting. Diversification is crucial. Don't put all your money in one stock or one type of investment. Spread your risk across different asset classes like stocks, bonds, and real estate. Time is your biggest advantage when building wealth. Someone who starts investing at 25 will have dramatically more money at retirement than someone who starts at 35, even if the late starter invests more money. The secret to building wealth is that it's boring. No get-rich-quick schemes, no day trading, no cryptocurrency gambling, just consistent saving and investing over long periods. What are investment risks you should know? Every investment carries risk. The question isn't whether to take risks. The question is which risks are worth taking. Market risk is the possibility that your investments will lose value due to overall market conditions. Stocks can crash, real estate can decline, even bonds can lose value if interest rates rise. Inflation risk is the possibility that your returns won't keep up with rising prices. If you earn 3% on your investments, but inflation runs at 4%, you're actually losing purchasing power. Liquidity risk means you might not be able to sell your investment quickly when you need cash. Real estate is illiquid because it can take months to sell a property. Some investments have penalties for early withdrawal. Concentration risk happens when you put too much money in one investment or one type of investment. If that investment fails, you could lose everything. Credit risk applies to bonds and other debt investments. There's always a chance the borrower won't pay you back. But here's the thing about risk. Not investing is also risky. If you keep all your money in savings accounts, inflation will slowly erode your purchasing power over time. The key is matching your risk tolerance to your time horizon. If you need money in the next few years, stick with safer investments like high-yield savings accounts or short-term bonds. If you won't need the money for decades, you can afford to take more risk with stocks. Diversification is your best defense against risk. Spread your money across different types of investments, different industries, and different geographic regions. Are financial apps worth using? Financial apps can be incredibly helpful or completely useless, depending on which ones you choose and how you use them. Budgeting apps like Mint or YNAB can help you track spending and stick to a budget, but they only work if you actually use them consistently. Many people download budgeting apps, use them for a week, then forget about them. Investment apps like Robinhood or Acorns have made investing more accessible. You can start investing with just a few dollars. But easy access can also lead to overtrading and poor investment decisions. Some apps round up your purchases and invest the spare change. This can be a good way to start investing if you're not disciplined enough to do it manually. But the fees can be high relative to the small amounts being invested. Credit monitoring apps can help you track your credit score and get alerts about changes to your credit report. This can be valuable for catching identity theft early. Banking apps from major banks are generally safe and convenient. They let you deposit checks, transfer money, and pay bills without visiting a branch. The biggest risk with financial apps is security. You're giving these companies access to your most sensitive financial information. Make sure any app you use has strong security measures and is from a reputable company. Another risk is over-reliance on apps for financial decisions. Apps can provide information and tools, but they can't replace financial education and good judgment. How do you plan for financial emergencies? Financial emergencies aren't a matter of if, they're a matter of when. Your car will break down, you'll have medical expenses, you might lose your job. The question is whether you'll be prepared. An emergency fund is your first line of defense. This should be 3 to 6 months of living expenses in a high-yield savings account, not invested in stocks, not tied up in CDs. Liquid cash you can access immediately. The amount you need depends on your situation. If you have a stable job and good health insurance, 3 months might be enough. If you're self-employed or work in a volatile industry, you might need 6 months or more. Building an emergency fund takes time. Start small. Even $500 can cover many minor emergencies. Build it up gradually by automatically transferring money from each paycheck. Insurance is another crucial part of emergency planning. Health insurance protects against medical bankruptcies. Disability insurance replaces your income if you can't work. Life insurance protects your family if something happens to you. Don't forget about less obvious emergencies. What if your income drops but doesn't disappear completely? What if you need to help a family member financially? What if you have an opportunity that requires quick action? The peace of mind that comes from being prepared for emergencies is worth more than any investment return. When you know you can handle whatever life throws at you, you can take appropriate risks with the rest of your money, ready to take control of your financial future. The concepts in this video are just the beginning. Subscribe for more simple explanations of complex financial topics. And remember, the best time to start building wealth was yesterday. The second best time is right now.